Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today we're getting into, what I should say is we're taking a step beyond some of the moving averages that some of us might already be familiar with. The simple moving average, the exponential moving average. We're going to be talking about building a trade system using something known as the whole moving average. I think that it's going to be an interesting discussion. Some of you are already familiar with this indicator. Others might not be so much, but we're going to be talking about why there might be a need by some traders for a new moving average, how that moving average is constructed, and how it might be used to build an example trade system. So all of that lays ahead. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Kelly and Elena, Josh, Zink, Dragon Rider, Scott, TMTM, Ted, Andrew, Art, everybody else, the Wire Rabbit. Great to see everybody. If you are one of our returning veterans, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy that recording. That's a great way to watch these webcasts. But you're also invited to join us in the live stream if you'd like to be here. This is a Friday webcast series, and we kick things off promptly at 1 o'clock Eastern time. Now, I also want to point out, and this is just exactly the right guy for this job today, we have my very good friend James Boyd. He's going to be hanging out in the chats with us. He's going to be addressing any questions that I can't get to that come in during the flow of the presentation. I say that he's exactly the right guy because James and I have been working together now for a couple of decades, and I know James well enough. A lot of you know as well, too, that he knows all about the whole moving average. He has a number of videos on our in our archives that address this topic. So thanks for having my back here, James. James and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there. It's a great place to connect with us in between these live streams. You can find James on X at James Boyd CS. You can find me there at Cameron May CS. And starting just a couple of weeks ago, you can also follow me on LinkedIn. So you can look for me there, linkedin.com/in/Cameron May CS. But let's get into this. Very first thing that we need to consider, of course, is the risks associated with trading and investing. These disclosures are important, so please keep them in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set the agenda for what we're going to be covering today. So this webcast is part of an ongoing series, and that includes we've placed some trades in the past, and we need to follow up on those. Right now, we just have one example trade in our paper money portfolio. So we're going to see how that one's coming along, see if anything needs to be done with it. Spoiler alert, probably not. Then we're going to take a quick look at the S&P 500 through our trend value momentum strategy set. That'll set the stage for our discussion of building a trade system using, I'm going to say, not just a whole moving average, but a combination of whole moving averages. So we'll talk about why some traders see a need for them, how they're built, and how they might be used to construct a trade system. Then we're going to put that example trade system into practice, planning and placing an example whole moving average trade today. That's a lot that we want to do. So let's get into this. Kevin says, I've heard of the whole once or twice from JB, I think. Lol, exactly. Yep. So let's go right to the Thinkorswim desktop trading software platform. And right now we have some shares of ATO. And those shares, woohoo, look at that, up $9. That's not $9 per share or anything like that. It's $9 overall, surrendering some gains today. But let's revisit the logic of this trade. And this was placed last week using what's called the 3 green arrows method. Now, if you're not familiar with that method and you weren't here to see this discussion last week, do yourself a favor and subscribe to our Trader Talks channel. You can go right down below the video right now, click on subscribe. It only takes a second. It doesn't cost anything. But our Trader Talks Schwab Coaching Webcast channel on YouTube is where we house previous webcasts organized into playlists. Now you can also join the live streams here, but for example, if I were to click on playlists and go down about halfway down the page, you'll find advanced charting techniques right there in the center. We can click on view full playlist. And there was building and trading the 3 green arrows method on a stock chart. So if you want to check out the logic of this trade system, you can go look at that. But basically, we entered on the combined evidence of 3 different technical indicators, took an entry on a trend signal along with 2 oscillators. And specifically, we're looking for 3 green arrows. And we had those last week. So we took our entry with the plan to sell if, well, it eventually should happen, but when we get 3 red arrows. Now, right now, we're kind of teasing with that first red arrow. If you look at the current value of our 30-period simple moving average, you can see that's at 175.71. The stock is at 175.90, so just 29 cents above that. Coming close, actually, just a few minutes before the webcast launched, this had slipped into red arrow territory, but it updates in real time. The arrow disappears as soon as we creep back up above that moving average. The other 2 are still showing green. So we're still in 3 green arrow scenario. Nothing to be done with this right now. So now, Thea says, did you lend your red shirt to Cameron? I don't know. Isn't this kind of rust color or something? Does it come through as red? Anyway, yeah, so let's have a look at what's going on with the S&P 500 to set the stage for adding a new position to this portfolio. Got off to a rough start today, right? If we're looking at this through our trend value momentum lens, and by the way, if you're not familiar with the trend value momentum chart trading system, of course, you can go to the channel. Quick way to find it is to just type in TVM, trend value momentum. There you go, understanding the trend value momentum chart trading system. Right, but this is the lens that we look through each week just to lend some consistency from one week to the next to our discussions. We look at this, look at the S&P 500 through the lens of a trader who uses the TVM system. So right now, let's load that up. Actually, I was thinking I have the TVM. I don't. I still have three green arrows on here. Let's go up to our studies. Let's load up our TVM strategy set. There we go. And we can see three different technical signals. First of all, trend. Trend by users of this method typically is identified as the 50-period triangular moving average rising and remaining above the 100, and that is the scenario right now. Prices come down, it's touched on that 50, and interestingly, also right along a trend line here. But we're starting to strengthen off of the session opens. We've actually come up quite a way. Really, the big major market indices all stretched down more than 1% down earlier in the trading session, but we're seeing some pretty good recovery so far. But this would sort of be a check in the box of the bulls using this trend method. Now we also see our RSI, which is sometimes used as our value method. It's kind of gotten down closer to the 40, more in the undervalued than the overvalued range in the short term. And it's starting to make a little uptick. That might be seen as generally a bullish indication. And finally, we have our MACD. MACD has actually slipped. So this is a momentum indicator, trend, value, and momentum. The momentum still seems to be with the sellers through this lens of the MACD histogram. So that might still be kind of tilting bearish. So it might be 2 votes for the bulls, 1 for the bears. Overall, maybe a trader who uses this might not be ready to step entirely on the gas, but maybe proceeding with caution might be an interpretation here. Now, obviously, time will tell whether that's the right thing to do or not, but that seems to be the environment that we're currently trading in. So now, let's learn about this different kind of moving average. So I'm going to bring up Apple for this discussion. First thing I'm going to do is just clear off all of the studies from the TVM set. And let's add a familiar indicator. I think this is going to be familiar to almost everybody watching, a simple moving average. It's the trend line tool. Sometimes, and actually let's switch this. I'm going to switch this to, let's say, a 20-period simple moving average. And that's for a reason that I will disclose at a later moment. Let me click apply and click OK. And so now we're looking at at the 20-day simple moving average, which for some traders can be used potentially as an indication of trend. It might be used as an indication of price floors and price ceilings, support and resistance. Also, it might be used to generate trade signals on what we call price crossovers. But in any case, when using a simple moving average, this is the first thing that a whole moving average attempts to address, and that is something known as lag. A simple moving average looks at the last, whatever period we've selected, and generates an average price for that period and plots that on the chart. Now that creates an inherent lag. It's just built into the system. So price tends to move ahead of the moving average. And at most times, there's a degree of separation, even when we're using something as relatively quick as a 20-period simple moving average. So for some traders, they see that as a potential, not a defect, but possibly a conceptual shortcoming of a traditional simple moving average. And so they might want to adjust for that lag. Now, there are some potential ways to address that using the moving average itself. So for example, if we want to reduce the time frame in lag between a 20-period moving average and current price, what might the trader do? Maybe they just use a shorter term moving average. That can address some of that lag effect, but shorter term moving averages also tend to be more volatile. They can produce more whipsaws. So not a perfect way to address, and obviously in technical analysis, nothing is perfect, but it's kind of trading one possible issue for another possible issue, exchanging lag for volatility, also generally described sometimes as smoothness. All right, now another thing that a trader might do is just go for a different moving average altogether, like an exponential moving average. An exponential moving average typically has less lag because of its weighted nature than a simple moving average. So it hugs a little bit closer to price, but it also has that volatility issue. Exponential moving averages tend to be a little bit more volatile than simple moving averages and might generate more whipsaws. So here are the two problems confronted by some users of moving averages. Number one is lag, and number two is volatility, or we also might call that smoothness. If you have something that's moving around quite a bit, it's not smooth, it's jagged. So maybe we want to introduce some smoothness into that while also adjusting for lag. You get that? You get the visual? Those two issues are what Alan Hull had in mind when he created the whole moving average. So I'm going to add a whole moving average to our chart, and you'll see why I chose the 20-period simple moving average as my default here. Let's come up to our Edit Studies icon, and I'm going to type in Hull. Let's add that to our chart. There you go. The default construction, according to Alan Hull, this is intended to be used over a relatively short period of time. 20 periods is the default. So I wanted to compare sort of apples to apples, I guess is the way that I would say this, comparing a 20 simple moving average to a 20 whole moving average, and click Apply, click OK now, and we can see now these two very different moving averages. Now, if I were to add an exponential on a 20 period basis, there's not really a lot of difference between a simple and exponential. Exponential will tend to be a little bit more reactive to recent price, but the two really wouldn't see much of a distinction. A 20 period whole is going to be significantly different than the simple moving average and the exponential. It is designed, and I'll tell you how it's designed in just a moment, but it is designed to hug much closer to price. All right. So we've adjusted for lag, and you can also see it's pretty smooth. It doesn't just jump up and down and hug right close to price and reactive day to day. It's fairly smooth in attaching itself to price. So let me talk about how that's accomplished, and then how this might be used to construct a trade system. All right. So let's come up here. I'm not going to be talking about the simple moving average anymore. We just wanted to have that as the backdrop for the discussion of the whole. So here's our whole, just the default 20 period. And I wanted to quickly lay out. I'm not going to go deeply into the weeds on the construction of the whole, but I did want to lay out in my own language how this is constructed. I tried to make this as straightforward and digestible as possible for as wide an audience as possible. If you want to Google after this webcast is over, if you want to go look up the specific algorithm that's all spelled out in an equation, you can go look that up. I don't think it'd be useful to get into that, but I did want to talk about the concepts of how this is constructed. So first of all, the way that I summarize this, it's kind of a four-step process. The first step is to calculate two what are called weighted moving averages. Very simple to an exponential moving average. A weighted moving average just literally gives the greatest weight to the most recent price activity. So on a 20-day moving average, the most recent day is going to carry basically 20 times the weight as the first day from 20 days ago. So we calculate two weighted moving averages. These are those two. The first is what's known as a full, and the second is known as a half. So a full just means we look over, in the case of this 20, we look over the last 20 days and calculate a weighted moving average for a 20-day period. And half of 20 is 10. So we look over the last 10 days and calculate a weighted moving average for that time frame. Okay, so we calculate two weighted moving averages, step number one. Step number two is we take that half, this one, that half moving average, I should abbreviate this to WMA to be consistent here, and we multiply that by 2. And you might think, well, wait, Cameron, aren't you just saying you're taking 10, multiplying it by 2, and you get 20 again? No, we're not doing that. Instead, we're looking at the outcome. We're looking at that weighted moving average over a 10-day period, and then multiplying that value by 2. And then from that, we'll subtract the full WMA. Now, what this is doing, the first one here, the first part of this equation is an adjustment for lag. Looking not just at the full length time frame, but also the half length time frame, attempting to adjust the creation of the positioning of the moving average a little bit forward. Now, this is the smoothness element. Okay. Taking that half length WMA and multiplying it by 2 and subtracting the full WMA. Now, there are two more steps. Next step is to take the period length, the 20, and we get a square root. Yeah. A square root of the period. And then finally, we generate a third weighted moving average from the result of that square root. So these are the steps for the creation. It's a little bit deeper into the weeds. I realize that, but I also know my audience well enough to know that there are some of you out there, the kind of the engineers in the audience, kind of the tinkerers who like to know what goes on under the hood of the vehicle before you get in the driver's seat. So that is as briefly as I could, as clearly as I could, explain the basic construction here. Again, all of this goes into a nice little elegant equation that you can go Google if you want to. But that's the construction. Let's set that aside. I feel like I've done my role as an educator in going into those weeds. Now let's get into the trading of this indicator. The net result of this is an adjustment for lag and a smoothing element. Both of those can be pretty easily visually seen. Now, one of the results of this is the way that this is the outcome of this equation and the construction of the indicator is that it's traded entirely differently than a traditional moving average. A very common signal for a traditional moving average is to look for what's called price crossovers. Price gets down below the moving average and we buy when it crosses up above. Price is up above the moving average and we sell as we cross down below. Obviously, that's just talking about stock trading, could conceptually be applied to other strategies. But because of the adjustment for lag, well, a simple moving average, to phrase this a different way, a simple moving average actually, in some ways, relies upon the lag to make sure that the entry and exit signals don't happen too quickly. If we adjust for that lag, it speeds up those traditional entry and exit signals and can result in a whole bunch of whipsaws. So if we're doing price crossovers, using the HMA, the whole moving average, we might not wind up getting a buy signal here and a sell signal there and a buy signal here and a sell signal there and a buy signal here and a sell signal there. You can see how frequently price crosses above and below the whole moving average, and that can really undermine those sorts of traditional approaches. So how is it traded instead? Well, if you took a really close look, and for those of you who've been following James for a while, you would have already seen this. But if you squint your eyes, you'll notice that unlike a traditional moving average, there are two colors being used for the whole moving average. There's a green line as the whole moving average is heading up, and then when there's a reversal and it starts to head down, it turns to purple. Now that's kind of hard to see because they're both kind of dark colors. I'm going to make a modification here. If you'll forgive me, I'm going to come up here. Let's click on our little flask icon, and I'm going to change the down movement of the whole moving average to red. Okay, let's click OK, click apply. It makes it a little bit easier to see. And so one way that Alan Hull suggested this might actually be traded instead of looking for price crossovers is just what we call reversals in the moving average. So let's use our arrow indicator here. And when we get the red whole moving average transitioning, reversing to green, that can actually generate a bullish entry signal. And when it moves from green back to red, that can be the bullish exit signal, and vice versa. So that's fairly straightforward, right? There's a green, there we are transitioning to red, here's green, here's red. Boy, Cameron, this is looking absolutely flawless. You finally found the perfect indicator. No, I haven't. This is somewhat optimized because of the trend. Right? The trend's been pretty cooperative here. This moving average, like so many other trend indicators and oscillators, can really start to break down if it's giving signals counter to the trend or when the trend is flat. Okay. Paul says he's written personal alerts for the whole change in color. Okay, great, Paul. Yep. I'm not going to be doing that today, but I'll say, yeah, it can be done. But in any case, a trader can very quickly get whipsaw signals. Like this says to buy right here. Well, the stock was already here on that entry, and it's down here on that exit. And then we get another entry here, and another exit there, and another entry here. Oh, this one worked out a little bit better. Another exit there. This one not so well. Here's an entry here. There's an exit there, and I think you can see the point. Even back here, there was an exit. There was an entry. Let's put it up here. An entry kind of here, and an exit right there. That was potentially slightly profitable. But some traders prefer to try to create a system that might weed out some of those whipsaw or potential signals that are counter trend or when the trend is weak, as defined by a sideways trend. So a way that they might address that, this is kind of a common approach using whole moving averages, is actually to bring another whole moving average into the discussion, one that is longer. Typically, if we want to identify a longer term trend, we use a longer term indicator. So let me clean up this sort of cluttered chart. I'm going to right click on one of my arrows here. Let's clear up this drawing set. And let's add in a second whole moving average. So Michael says, so do you use the whole in conjunction with the SMA or EMA to know whether to stay in the position? So Michael, we could. Yeah, actually, if we were to use this in combination with, let's say, a longer term simple or a longer term exponential, that's a variation on the theme that I'm about to introduce here. But I'm going to stick with the whole moving average itself and just lengthen it. So let's stretch it out, make it a little bit less sensitive to near-term price fluctuations and look at longer-term trends. So let's come up here to our little flask icon and let's add another whole. Add that to our chart. And in this case, how about we dial this all the way up to, let's say, a 100-day moving average. And I keep saying day because we're using a 1-year daily chart. These sorts of techniques could conceptually be applied to like an hourly chart or a weekly chart. As with almost all technical approaches, they're portable from one time frame to the next. Now, obviously, they're not guaranteed to deliver profits on every single trade, regardless of the time frame. But the potential application. Could it be, let's say, taken off the daily chart and applied to the hourly chart? Yep. Anyway, let's change our 100 whole. We need to make it a little visually distinct from the 50, otherwise it gets confusing. So the first thing I'm going to do is, instead of having a nice solid line for the 100, let's change that to a dashed line. And let's also make it a little bit thicker. Thickness on a scale of 1 to 5, how about we make that a 3? Now, the dashed might work fine. I think that making it a little bit thicker makes it a little bit easier to see still. And finally, let's make the down portion red. Okay, we click OK and click Apply again. Let's click OK. And so now, here's the trade system that a trader might use, who's using a combination of whole moving averages. Not the only system. If we wanted to speed this up, we could use shorter term holes, meaning maybe a 10 versus a 50 or a 40. Typically, though, if we use the same similar ratios, we might have similar sort of trade systems. In any case, the concept here being the trader first looks to see, is the longer term whole moving average green? If it is, then we look for signals from the short term. Now, a little variation on that is if we already have a signal on the short term and then finally our longer term turns green on that day, that may actually be a signal as well. So it doesn't necessarily have to be that the long term is already green, but that it at least confirms at some point that we have a legitimate shorter term signal. So let's look at some examples here. So how about we look at some false examples first? Maybe that helps out. So you'll notice right here, just to revisit this one, there was a signal to enter right here, but at the same time, our longer term was red. So that would have disqualified this as a potential entry. Let's see if we have another one. Here, actually, this one, it wouldn't have filtered this one perfectly because there was a signal here, but the trend line actually started to confirm. So there might have been a trade taken right there, and it didn't work out, or at least it just didn't produce much of a profit. But most recently, as our longer term has been trending up, we might have seen a legitimate entry signal here with an exit there. Might have seen a legitimate entry signal here with that exit there. And not just justified on the whims of the trader, but on actually the confirmation of the trend. That's what's important here. So we have another legitimate entry here with an exit there. There's one right here, an exit right there. I hope that you're also seeing that this is not for those traders who don't like to be in or out of positions relatively quickly. Average trade here might only last a few days to possibly a couple of weeks. Looks like there was also an entry here and an exit right there. But what I noted today is that we have, I think, let's zoom in. Yep, it's green right now. Now, it actually turned green right around here. Price hasn't changed very much. So to a trader who's trying to refine their timing, price not really significantly changed. So they might still consider this to be a legitimate entry. So we're actually going to be trading Apple today. We're going to be buying on the evidence of an increasing 20-period whole moving average, confirmed by a rising 100-period whole moving average. But before we can place that trade, we need to have a plan for when we're going to take our exits. Now, for some traders, they might look to recent highs. There aren't really any recent highs except for those that are just above where we are right now. Or they just look for the shorter term transitioning back to red. Let's see, Ted says, if you're willing and able to search stocks, would using the inverse approach be a reasonable approach? I know that many bullish strategies don't work well for shorts or for bearish trades, right? Yes. Is this a strategy that could just be conceptually inverted, looking for red 20-period entries on a downward trending 100-period? Yes. So if we were to roll back here, as an example, let's see if we can find one. Here we have red on the trend, and we also have our 20-period is red. So In this case, we might have gotten the original. Actually, we could have taken that even back here, right there. Let me get rid of this signal, because that was actually a little bit late. So our shorter term is red, and we're saying nope, 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 nope. Oh, yes. Now we have the trend confirming the short-term signal, and we might take an entry. When might the trader take an exit on whatever bearish strategy they decided to employ at that point? Well, that would be if the shorter term starts to roll back up again. So actually, this bullish potential entry that we previously discussed can actually also serve as a bearish exit. So Ted, that's a great question. Let's see if I missed anything else. I don't think so. I think we're keeping up on those questions. Yeah, Greg, thanking Ted for the question. Yeah, I think that was a good question there. All right, so let's go back to our entry signal that we do appear to be getting, if not exactly today, at a similar price level within the last several days. Let's go ahead and take an entry in our example paper money portfolio. But here's going to be our plan for our exit. We need to be explicit. We're going to sell on a red 20 slow moving average. That's it. That's going to be our plan for exit. So we'll put that on our chart. I'm going to edit that to be blue. It's just like with our ATO, we like to outline the plan for exiting before we take the entry. So back to Apple. Let's go place our trade. We go to the trade tab. I'm going to buy some shares here. Typically, we spend about $5,000 on a given trade. 10 shares would be about $2,700. 20 shares, it's going to be about $5,500. I'm going to buy 20 shares of Apple. Let's just click on the ask price. Buy those shares. I'm going to enter a market order here. Now, obviously, when entering a market order, we need to remember this. With market orders, prices can change quickly in fast market conditions. Prices can change quickly even if the market conditions have been slow up to that point. You can all of a sudden just take a jump. But particularly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So just because we're seeing 274.70 as the current price doesn't mean that's what we're guaranteed to receive. When we submit a market order, we get what we get. Now, there's no commission on this trade, but there can be on some types of trades. Let me send this order off, and we should get here. It's working. It's just a market order. Let's see where we fill. Okay, we bought that at 274.73. And we are just going to see now with shorter term traders, quite commonly, they like to set targets or stops. With this sort of an approach, we might not employ either one of those because if it goes up, we don't know when that might transition to red. If it goes down, it will transition to red as well. We just don't know when that will happen. But we're going to let the indicator itself work as an indication of when to take profits or when to take losses. All right. So guys, going to be kind of a shorter one today. I hope this was an interesting discussion to you. I wanted to get a little bit deeper into the construction of the whole moving average. Not every time that I've discussed this in the past have I gone through exactly how it's constructed. So I wanted to make sure that we got a little bit further into that. Somebody just asked the question, how would I use this to construct an option trade? In this webcast, I very intentionally deliberately stay away from options trades because then I have to explain that strategy and it becomes less a discussion of charts and more discussion of options. Now, I actually teach regularly scheduled webcasts every week on options trading, so you can go check those out. Certainly invited to. I'd love to have you watching those webcasts. But in this one, let's just say that if it's bullish, could a bullish option strategy be employed? Yes. Is it guaranteed to perform? Nope. Our stock trade isn't guaranteed to perform. Okay, Corey says, does whole work better or worse on any type of stock or ETF? That's a really good question. We don't talk about ETFs in these webcasts because the rules governing ETF-related webcasts are very different. In any case, but are there specific stocks that they're inherently better better aligned with the way that whole moving averages work, or not in my experience. It even on a stock where it has worked in the past, is not a guarantee that on this trade it's going to work. And on some stocks where maybe a specific system hasn't really worked very well, maybe it'll start working. Now, it could just be because the stock has been really volatile and has been whipsawing every approach, including whole moving averages, and maybe it slows down. But no, there's not anything that I can give you as like a look for this and not for that sort of a inherent characteristic of a stock that one might apply this to. Okay, good question. But guys, time for me to let you go. You've earned your Friday. I'm going to let you go enjoy the rest of your Friday and your weekend. We have other webcasts coming up still on the slate, so go enjoy those. James, thanks for helping out in chat. It's always appreciated. When I saw that you were the chat support for this, I was like, we're in good shape here. So thanks for being there, James. But James and I would like to issue an invitation to you to make sure that you are availing yourself of the full range of educational resources available to you from Schwab Education. So first of all, if you haven't subscribed to our Trader Talks channel yet, do that now. You've already seen the kinds of value that can deliver with the playlists, you can join the live streams, you can even do a keyword search for topics of specific interest. Now, we'd also love to have you following us on social media. It's the best place to connect with us in between these live streams. So you can find James and me on X. You can find James on X at James Boyd CS. You can find me on X at Cameron May CS. And if you reply to one of my posts, I just try to reply right back to you. And that allows for communication that otherwise couldn't really happen when the camera's not on. Now, just starting a couple of weeks ago, you can also now follow me on LinkedIn. So let's pop over here to LinkedIn. I'll show you how to find me. So here's the address. Here's the URL. A little bit longer than finding me on X, but not too hard. LinkedIn.com/in is the way to sort of get to LinkedIn generally. And then you just add the /Cameron May CS. LinkedIn.com/in/Cameron May CS. And you'll find me there and you can follow me there. And I have 116 followers right now. Got about 17,000 on X. But if I make a post here on LinkedIn and you reply to that post, I reply right back to you. All right. But guys, that's going to do it for today. Go enjoy your Friday and your weekend. Thanks to everybody who's already clicked the like button. Got 145 people watching, and 46 people have clicked the thumbs up already on YouTube. Thanks for doing that. That's very much appreciated. To me, that sounds like 46 people out there saying, Cameron, great job. Thank you. But I also want to let you know, when you click that thumbs up, when you click like on YouTube, that tells YouTube, hey, I liked this. It's not just for the presenter, but it also communicates to YouTube, this was a good video. You ought to show it to other people. And it allows more people to find our videos and learn about stuff like trading with whole moving averages. So thanks for always clicking up that thumbs up if you enjoyed a webcast. Everybody, I will look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.